So I'm going to introduce our speaker, Kristen Jacks. She is going to be our speaker and moderator of the Investing Discussion Group. Kristen Jacks is a financial
Dang, get a
educator,
leg off
author,
or
and
fired.
the founder. Can we just mute our audio,
Well,
everybody? And the founder of
I
Money in
think
Your 20s.
basically
Oh,
he was in the senior management.
okay. We took care of that. Kristen Jacks is a financial educator, author, and the founder of Money in Your 20s. Kristen worked for Kiplinger's Personal Finance magazine and Mutual Funds magazine before becoming a writer and speaker. Her most recent book on investing is a lively and jargon-free resource for young adults or anyone new to investing. Kristen is a graduate of Duke University. And before I hand it over to Kristen, I just want to say that we are recording tonight's session. So we will send this to everybody after the fact, and I will post a link in our chat for everybody to register for next month's session. All right. Thank you, Kristen.
Thank you, Caitlin. And thanks so much to Greenwich Library. You guys do wonderful programming. I really appreciate you. Okay, welcome everybody to the Investing Discussion Group. We are halfway through season 4. We've tackled some really great topics, and it's just been so much fun. And I just, hopefully you'll see through my slides that I just devote myself to this and I enjoy doing it. And hopefully it's going to be lively and interesting for you as well. We're tackling a lot of topics this season. And if you feel like you missed anything, you can find past episodes on YouTube. Like asset allocation was a very popular one. It's the Economy Stupid was a fun one where we're looking at all the macro things that happen, like tariffs and how that impacts investing. So all of these past episodes live on the library's YouTube channel. And if you want to find that, you go to YouTube and then in the search bar for YouTube, enter Greenwich Library, and then you'll see this logo, this green and white logo of the open book with the tree inside. And you click on that, and then that'll take you to all of the past videos. I'm not sure, I haven't checked it recently, but I think tax-free retirement still remains our most popular one. Although we had a really good one 2 years ago on investing in real estate. That might be the most popular. I'll have to go check. But anyway, if you feel like you missed anything, definitely check out the library's YouTube channel. Okay, so today in planning ahead, today we're going to cover bonds, and then planning ahead, we're doing everything about scams. Okay, so there have been some horrible scams out there, and the scammers are getting really, really sophisticated. So we'll do some storytelling, some real, truthful, real stories of people who got scammed and really lost their money and it was not returned to them. And then we'll talk about how you can protect yourself from financial scams. So that's in February. Okay, and then of course, a little disclaimer because this webinar is for educational purposes only. It is not intended to provide investment advice. None of the investments or investing strategies mentioned in this discussion group are specifically recommended or discouraged. Before making financial decisions, you are urged to consult a wide range of professionals, tax expert, lawyer, financial advisor, who are aware of your unique needs and situation, okay? Okay, and also please participate. So we're going to mute you if we think there's like accidental noise in the background, but if you want to participate, you can always unmute yourself and ask a question or just make a comment. There are lots of smart people out there who've had a lot of experience with different investments, so please feel free to participate. And if you're feeling a little shy or you don't know when to jump in, you could always write a question or make a statement in the chat. All right. So this is all about bonds. All right. So what is a bond? I really liked this definition. A bond is basically a promise to repay a specified sum of money according to rules. That's what specified rules, things that are set when the bond is issued. Like, why do I like this definition? Because you're noticing the structure, right? Unlike equities, that, bounce around and there's no guarantee for the future. Bonds are meant to have a guarantee of the future. Bonds are meant to give you the whole picture up front of how long the loan is going to last and exactly what you will be repaid and exactly what interest you're going to earn. That's at the outset, right? It doesn't stay that way because there's a secondary market where bonds are sold, bought and sold. But at the outset, each bond is a promise to repay a specified sum according to these rules of what exactly is the interest rate, how long is the maturity, or, when is the maturity date. So it's very, very, very structured. So it's a loan with a lot of structure. And there are all sorts of bonds out there. Our government issues bonds called treasuries. Different businesses issue bonds called corporates. Municipalities, towns, they issue bonds called munis for municipal. School districts, that falls under municipals. And we even have bonds that are pooled, mortgages pooled together, and they're called mortgage-backed securities. So we're going to cover all of that. But the real gist here is that a bond is a promise to repay a specified sum, and it's very structured. So from the outset, exactly what that bond is like is all in the fine print, okay? And it's not supposed to change. What changes is when bonds are sold on a secondary market, that's why you see these changes, okay? So it's really like if you were just going to hold a bond to maturity, you already know everything about that bond that you need to know. If you were just going to buy and hold, it's only in the secondary market where things kind of go haywire unless there's a major problem like a default. Okay, but we only have 55 minutes and the bond universe is enormous. So how are we going to pare this down? Well, this is an introduction. So we're going to do the bond basics. So just and briefly, and so this is not going to be boring for people who have a lot of familiarity with bonds. We're going to get to the good stuff, but we have to start with the basics. So we're going to start with the basics like the CUSIP number, the coupon, the maturity, the yield. Then we'll move on to what the most common bonds are, so you're not left in the dark about treasuries, corporates, munis, things like that. Then we have to, so that you really understand how bonds operate. Well, I don't want you to panic, but you're going to have to understand price and yield and why they fluctuate, right? So don't panic. It's just math. We're not going to do a lot of math, but I said bonds were very structured and what you see is what you get. And then the truth is on the secondary market, things start to bounce around. So it's like, well, if a bond has a face value of $1,000 at the maturity date, you're going to get your $1,000 back. How is the price changing? Isn't the price always $1,000? Well, no, it changes because in the secondary market, it changes. Isn't the yield always what was originally agreed upon when the bond was issued? Well, the coupon never changes. The payout, the yearly payout never changes, but that doesn't mean that the yield doesn't change, again, because there's a secondary market. So don't want you to be confused. We'll explain it. And then what are the big risks around bonds? Interest rate risk, credit risk. So we're going to cover that. And then at the end, we're going to get down to these wonderful inflation protected options, right? So, and they are relatively new in the universe, the life, the 100 years of bonds in America. You've got relatively the idea of inflation protection actually being something that you can count on is relatively new. But there are tips and I-bonds and other ways to get that inflation protection. So we're going to cover that. And then if we have time, we'll do even a little bit more. But this is what we'll definitely cover in the next 55 minutes, now 51 minutes. I'm just going to check the chat real quick because I see there are 3 things in there already. What do we have? What do we have? I don't see 3 things in the chat. That's weird. I don't know. Caitlin, maybe you can tell me what I'm doing wrong because I don't see three things in the chat. Okay, so moving on. Bond basics. All right. Believe it or not, this is an actual bond. I went on my Schwab account and I looked at an actual bond from Johnson & Johnson. So of course, we're talking about a corporate bond here because Johnson & Johnson, a very well-known business, is a corporation. And this is a true bond that they issued. And so you see that, It's Johnson & Johnson. You see the company name. Then you see this 3.55%. Okay, so that's the coupon, right? So right at the time that the bond is issued, the coupon and the yield are exactly the same. Sometimes that's the only time in history they remain exactly the same. So if you were able to buy a bond right as it's issued, which probably as an individual you're not able to do, you're buying on the secondary market. But if you could buy right as it was issued and you gave your $1,000, then you know that you're earning 3.55% on that $1,000 because that's the structure of the bond, and it does not change. The coupon does not change. For history buffs out there, if you're wondering why it's called coupon, because it's the yield on the bond, it's like your interest on the bond. It's because bonds used to be issued as like physical paper things, and there was a literal coupon that you would tear off and redeem in order to get your interest payment. So in this electronic world, that seems very quaint, but that's where this weird word came from. Because until you get to be a certain age, coupon always means like something you bring to the grocery store to get a discount, right? So for bonds, coupons, the coupon is the interest that you are earning on the bond. So we've got our Johnson & Johnson, we've got a company that issued this bond, it's a true bond. And then they're not repaying it until 2036, right? So they issued this bond and they're not repaying it until 2036. So this is a very long-term bond, right? If you look down, so go past issuer, company name, sector, it'll say maturity date. So that's what that is. Like they're going to give the money back on that date. Up until that date, what they are doing is semi-annually paying the coupon, right? And the coupon doesn't change. So it's usually easier to just think about it in dollar amounts, okay? So the dollar amount that Johnson & Johnson is paying on this bond every year doesn't change. So if you have 3.55% off of $1,000, that's $35.50, right? It's semi-annually. So that's $17.75 every 6 months, right? Twice a year. So that cash amount, if you were able to get this bond at the very beginning, that's the cash amount that you would receive semi-annually, and that does not change. What changes in the secondary market is that this bond would not be competitive, right? If you wanted to buy this bond today, you wouldn't really be willing to give $1,000 for something that only earned 3.55%. So what ends up happening, and we're going to really get into this later when we talk about price and yield, is that you're going to buy this bond at a discount. You're not going to give the full $1,000 because that's, and this is where the math comes in. This is how you end up with the higher yield. But for now, like here are the bond basics. You have this Johnson & Johnson company, you have this CUSIP number, CUSIP, and it's always some funky number with, some numbers and a letter. That's just an identifier, right? There are so many bonds out there, hundreds of thousands of bonds, that we have to say give something its very own unique number. This seems a little geeky, like why am I telling you this? But honestly, if you ever want to trade bonds directly on a brokerage account, sometimes you find bonds by putting in the CUSIP number. So it's helpful to know what it is and that it's unique. Every bond has a unique CUSIP number. Okay, so we've got our CUSIP number. We know it's a corporate. We know it's Johnson & Johnson. And then we have our coupon rate. It's important that it says it's fixed, so that coupon's not going to change. The coupon's going to be paid semi-annually, and then you have a maturity date. So this is really what a bond is. It's this very structured loan that from the very beginning, the interest rate is known and the maturity date is known. And as long as nothing happens to this Johnson & Johnson entity, they're going to stick to what they promised. Okay, so what are the most common bonds? Now, I could have shown you the exact same profile for a treasury. I could have shown you the exact same profile For a municipal bond, right, there's going to be a CUSIP number. It's something unique for each one of these. There's going to be a coupon, right, a promised interest rate at the very beginning. It's going to say whether it pays semi-annually or annually. There's going to be a maturity date, a time when the bond, retires and the money is returned at the face value, right? And that's very important. So if we're thinking in increments of $1,000 is returned to the bearer of the bond along with the last coupon payment. So what I just showed you would be true for all of these bonds. But they have different features that make them attractive for different reasons to different people. So let's go over those. So treasuries, that's, from our federal government issuing these bonds because our government needs to raise money. And I'm sure you know that our treasury market is enormous. The government borrows short-term, medium-term, long-term, all day, every day, all the time. There are a lot of bonds out there. And so what are the defining features of treasuries and why do people buy them? Well, with treasuries, it's really important to think of treasuries as what is considered the risk-free rate, right? A lot of people, it's like, if the United States, you have the full faith and credit of the United States, and if the United States is going to start defaulting on bonds, pretty much the idea is that the world is coming to an end. So, there's no universe where the government's just going to default. This isn't Mexico. This isn't Chile. This is, we're going to make good on our bonds. So people flock to treasuries because they think of them as the most safe. So this is the risk-free bond at all different maturities, right? So you could do a 1-year bond. You could do, they're called different things. So they're called bills. So there's treasury bills, treasury notes, treasury bonds. They're all lumped together under the bond name, but they have sort of these different subnames based on how far out the maturity is, right? So if it's less than a year, then that's a bill, a treasury bill. So you could just purchase a treasury bill that's going to mature in less than a year. There are treasury bills, I can never remember what the shortest one is. I think it's 4 weeks, but they're super quick. And there are ETFs out there that you can buy that, they're just pooling together these super, super short-term treasuries. So if you want kind of the most safe, it's going to give you the least amount of yield, the least amount of interest. But if you don't want your money sitting under a mattress earning nothing, then going into these ETFs that just focused on the short-term treasuries is a way to make 3.5% basically on your money, and they're very popular and people do it. So the allure of treasuries is the risk-free idea. And then also it's just interesting. And I was like, it's so funny. There's no state tax on the interest from treasuries, which you would think it's like the federal government. So wouldn't they control federal taxes? But I guess, sorry for the states, that's just the way this works. And the treasuries are highly, highly liquid, right? So if you were ever going to buy one, or if you're going to participate in a mutual fund that focuses on short-term treasuries or any treasuries, if you're going to be in an ETF that's all about treasuries, you'll always be able to get your money back. It's highly liquid. If you buy in and then you change your mind 2 weeks later, you'll get your money out. The value might have changed slightly, but it's very safe. Okay, so that's treasuries. Corporates, so these are the big companies in the United States, and a lot of the big companies, the recognizable companies, issue bonds. So there are true bonds out there from Apple, from Microsoft, from Ford, from Starbucks. So if knowing specific companies helps you, if it makes it more real to you, just know that companies that are very familiar to you are issuing these bonds, have issued these bonds. And you can buy them on the secondary market. So what's the deal with corporates? Like, why do a corporate versus a treasury? Well, in theory and historically for a while, corporates just paid a higher yield. Like you were getting, if you want to do better than 3.5%, 4%, if you go to corporates, maybe you're getting 4.5%, 5%. So there's going to be a difference in the yield. And if you believe that these are super solid companies and the rating agencies, and we'll talk about what they are, that there's this like third party that agrees that these companies are very solid, why not try to get more yield? So that's the deal with corporates. So people, why are they interesting? Well, you're going to get compensated in theory for taking greater risk, because anything is more risky than the US government. Now, recently, you haven't been compensated that much, right? So there's a lot of discussion about like, should you even bother? Because if you can buy a treasury and that's as safe as it gets, why would you do a corporate bond? Because you're not getting the yield that you should. So I'll show you in a minute, like, actually, maybe I'll just show you now. So I know this is a lot of numbers. But if, I have a Schwab account, I log on to Schwab, and they're going to show me sort of a snapshot of all these different maturities, right? So if I want to buy, and it's not necessarily bonds that, were just issued that mature in 4 years. That's not exactly what this is showing. It's basically bonds that have so if you look at the column of 4 years, it's like bonds that are going to mature in 4 years. Maybe they were originally 10-year bonds, but they only have 4 years left. But basically, you can go to this menu and anything you're interested in, whether treasuries or corporates or municipals, you can see on the left-hand side that those are the different options. And then across the top, you see when are they going to mature? And then when you look at those maturities, what kind of yield are you getting, right? So you can, if you want to hunt around for yield, if you're like, you know what, I want more than 5% yield. Well, you're not going to see a lot. Is there even anything? There's nothing, 5% yield unless you do a 10-year or greater maturity. So this is how you can kind of learn that, taking the risk of basically tying up your money for much, much longer will get you the higher yield. But also when you look at that 10-year column that I highlighted, you see dramatic differences between say a municipal bond. So again, this is bonds that are being issued by municipalities, towns, town governments, things like that. Well, if that's only paying 4%, but you can clearly see that you can get almost 5% by this, AA rated corporate bond, then, why would you ever do them? Why would you knowingly take less yield? So this is all the stuff that you're going to learn when we go back to looking at municipals versus corporates versus treasuries, is that, you have certain risks and you have certain tax consequences and liquidity and all these things factor in. But the biggest deal with municipals and why they are attractive to some people is that the interest you earn on municipal bonds, there is no federal tax. So it's kind of funny to me. So it's like you've got the treasuries where you don't pay the state tax, which is not intuitive to me because the federal government, it's issued by the federal government. So you would think that they would waive the federal tax. But the municipalities that don't control federal tax are the ones saying you don't have to pay federal tax. So it's hard until you get used to it. It might be hard to remember, but that's the big allure for municipals. Well, why is it a big allure? Well, okay, not me, but Taylor Swift, certainly, very, and her boyfriend and any famous athlete, their annual income is astounding, right? And we have a progressive tax system. So they're paying the absolute highest, they're in the highest tax bracket for those final dollars that they're earning are getting taxed at 37%. So if you can actually make money and not have it bypass that 37% haircut, that's fantastic, right? So of course that municipal bond is attractive to people who have these super high incomes. Even people who are in the 35% or 32% bracket are really interested in municipals because that's a very, very big hit, versus there are a lot of people hanging out, especially retirees, hanging out in the 10% or 12% income bracket. I mean, if you think about it, it's like retirees, they've saved and saved and saved. They might own their home outright. They might be living off of savings. They don't have the super high incomes anymore. So municipals are irrelevant to them even though they like bonds. But meanwhile, somebody in a super, super high income, they're really looking for that savings because they're going to get gouged with 37% or 35% or 32%. So that's the big attraction with municipals. And then the final one, let's go back to it. You'll hear a lot about mortgage-backed securities. If you delve into this and you really want to understand everything that you have access to, or if you're going to buy into an ETF, the actively managed bond ETFs are becoming hugely popular. And so you'd have access to some of the smartest bond managers that are actively buying for you. And they like to mix it up, right? They'll call it multi-sector. They're trying to get you the most yield with the least risk, and they don't want to tie their hands and saying they're only doing treasuries or they're only doing municipals. I mean, there are investments like that stick to only one or the other. But if you see multi-sector, that means, some really smart bond manager is like, just let me cook, like, let me mix up anything that's going to be good for you that has the most yield with the least risk. And they're going to want to go into mortgage-backed securities. So that's why I mention it. And again, the greater compensation is the issue there, but you have a lot of prepayment risk because if rates go down, people are going to prepay their mortgages. And you also have credit risk and things like that. That's why we had the financial crisis. Okay, so that was the most common ones: treasuries, corporates, munis. Hopefully that made sense to you. And now we're going to, by the way, so the library has a copy of my second book, which is all about investing. It's your lively, jargon-free guide to getting started. And I wrote the book for people like, in their 20s. My first book was Money in Your 20s. But what I've noticed is the off-label use of my book is that anybody that delayed really learning this stuff in their 20s just really gets a kick out of my book because it's very lively. It tells great stories. I talk about Starbucks and Apple and all these guys, and it just makes these bonds come alive. And I get back into like the coupon and the CUSIP and everything. So you'll know it backwards and forwards. And so chapter 5 is where I really delve into this. And if anybody just wants a free copy of that chapter, I will email it to you. So my email is kjacks@moneyinyour20s.com. It's also, you could share it with your kids, share it with your nieces and nephews. And also, I think the library has 2 copies of my book at least. So you could always come in and just read the whole thing. But if anybody wants, just one chapter that really covers those basics so that there's no chance that you or a loved one does not understand what these bonds are, I'm happy to give you that. And also, I think, Caitlin, maybe you should put your email in the chat because it's just going to be a PDF of the chapter. And then if somebody emails you, they can get it from you as well. Okay, now don't panic. We are at the halfway point. You've been listening very well. Now we're at the halfway point of the webinar, and it's a time for a little math because everything I just said, which was true, that a bond is very structured, and when a bond is first issued, it's going to have a coupon, which is the yield on the bond, and that never changes, right? Well, if the coupon never changes, then why does the bond yield change? I'll tell you. And if the face value of the bond is always $1,000, then why does the price change? I'll tell you. Okay, so this is, if you're really going to understand bonds, you have to understand that once it's issued, then life takes over, right? So whatever that issue was, whatever that deal was, say it was a bond at 3%, and then you realize, life goes on and interest rates start going up, up, up. And all the folks that want to issue the new bonds, they have to issue them at a more competitive yield because 3% is not going to do it anymore. So then all of a sudden there are these new bonds being issued that pay 5%, right? Well, what does that mean on the secondary market? All these older bonds floating around that are only paying 3%, nobody would ever buy them, right? So now we have to understand that's why the face value never changes, the $1,000, but the actual price you're going to pay for a bond could either be lower or higher than $1,000, because that's the only lever we really have to adjust the yield. Okay. So let's try this. Hopefully this isn't too scary. And these are real bonds. Okay. And this is what I talk about in my book. I try to use real bonds. So you have the Apple, right? Beloved company, super safe company, great company. Well, a while back, when interest rates were super low, and also Apple is highly regarded and nobody thinks they're going to default, they were able to borrow a bunch of money at a very, very low coupon, right? Paying a very, very low yield. So they issue these bonds, and now it is true that it's like the average person isn't really getting their hands on only $1,000 worth of this issue, but for the sake of doing the math, you know, I mean, and some bonds are not, you can't even, like, they're not even issued that way. There'd be increments of 25,000 and things like that. But to make it more easier to explain, it's like, just think of bonds as increments of $1,000 that you can access. And Apple issues these bonds. And, you know, at the time, they were raising millions and millions of dollars. So it gets, you know, cut down into these $1,000 increments, but they're raising millions and millions of dollars. And they're only paying 1.8% a year. So that's only $18 a year. That's the number that doesn't change. So they've issued this bond. They know, you know, whoever holds the bond gets this $18 semi-annually. So they're going to get $9, and then 6 months later, another $9. But that $18 a year doesn't change. But the world changes. So even though Apple is beloved, even though Apple is so solid, no one's going to want that bond when really, really excellent companies, equally excellent companies, are now paying, you know, a few years later, they were paying 3%. A few years after that, they were paying 4%. So you see how this works, right? It's because interest rates went up. So then these bonds, in order to be competitive, the new issues had to offer a higher coupon. They had to promise at the outset to pay a higher coupon. Now, the coupon and the yield is the exact same the first day the bond is issued. After that, it goes to the secondary market and anything can happen. So, well, what are we going to do? Apple, you know, needs to be a liquid bond. It needs to trade on the secondary market. No one's going to want it at 1.8%. Well, this is where the math comes in, right? Because what you can do is take that $1,000 face value, and the new person purchasing that bond is not going to pay $1,000, right? So if they want if they're only willing to do a competitive yield and the price gets lowered, so the new person only pays $970. So this is a very short-term thing. So I'm saying that this bond is maturing like within a year. So the new person buys it on the secondary market only for $970, the 1,000 face value bond. Well, that means when it matures, and this one's maturing in a year, they're going to get $1,000. So they paid $970, but they're going to get $1,000. So that's like a $30 bump right there, right? So they're going to get $30. They're also going to get the $18, right? The two semi-annual payments. So they paid $970, and they're going to get like this, the $48. Oh, I actually already see my math error. Okay, it's a little higher. The yield's a little higher than 4.8 because I should have done it off the base of 970. But hopefully you see my point, is that what ends up happening is if you pay a discount price, so this is a discounted bond. If the price is discounted, you're paying less than the 1,000 because you're going to get the full 1,000 back. And then you take that difference, and that is like getting extra yield, right? So that's how you go from the 1.8% coupon to a higher yield, by paying less for the actual bond. So that's when they say a bond is trading at a discount, that's what they mean. That's a discounted bond. Now, believe it or not, I mean, I think we all remember when the yields on bonds were terrible because we got into this super, super, super low interest rate environment where even 10-year bonds, the 10-year treasury, was hovering at 1%. It was shocking. So we did have that episode in our history. But prior to that, I don't know how old you are, but prior to that, we've had some crazy high interest rates in this country. So a long time ago, the Ford Motor Company, they issued a bond at 8.9%. So the coupon's 8.9%. Well, nobody is going to get that deal today, unless the company is total junk, unless it is a high yield junk rated bond. So if you're a good company and you're not junk rated, you don't have to pay 8.9%, right? So if you're a good company, maybe you're paying, it depends on the maturity, right? But maybe you're paying, 5.5%. Okay. So how are we going to get this, so who's going to buy this Ford bond, right? Well, anyone would love to get it, right? Because it's literally paying the $89 a year. So the coupon was 8.9%. So it means it's paying $89 a year. Well, I would love to get $89 a year by giving you $1,000, but no one's going to make that deal with me because they don't have to. So what ends up happening is, in order for this bond to kind of fit more in the secondary market, the only way I could get my hands on it is to pay more. So the first bond that had a low coupon, I get to pay less. The second bond, in order to get that cash flow of $89 a year, I have to pay more for the actual bond, right? So instead of paying $1,000, I'm going to pay $1,150. And then I can't remember exactly when this matures, but you can imagine how I'm still getting my $89, $89, $89 every year. But then when when the bond matures, I only get $1,000 back. So right at the maturity, I have lost $150 because I paid $1,150 for the bond. That's a bond premium. That's the premium bond. So I paid more than I knew what I would get back at the maturity date. But the whole point was so that the math would work out, that my yield was closer to the prevailing rates at the time, right? So I got to go back to my notes and figure out exactly how this worked with the maturities and things like that. But I was trying to show an example of how you get down to like a 6% yield when the original coupon is 8.9%. And what you do is you pay more for the bond. And so then when it matures, you've kind of lost money in terms of the price you paid, but because you've been getting the $89 every year, and that's such a good payout, it sort of evens out. So bond math is actually, like, if you've ever looked at it in a bond math book, it's very intimidating. It's it's a true turnoff, but at least understanding that, how, when interest rates move and the competitive secondary market, how does a bond that has a low coupon compete with bonds with higher yields? The price is going to change. So it's the actual price of the bond that's always changing to adjust to what is needed in the secondary market based on interest rates. I know this is confusing. You can watch it again on YouTube, or have, someone who's really good at this walk you through it again. All right. Interest rate risk and credit risk. We've been talking basically about already interest rate risk, because you can see how the Apple bond, really, like, the interest rate at the time was, when it was issued, 1.8% was good enough, but not at all good enough when interest rates went through the roof. So let's drill this down. I'm going to make a little joke here. This is in honor of my father. My father loved Steve Martin's, he loves Steve Martin, who's still alive, but he loves this comedy routine Steve Martin did back in the day, where Steve Martin is Socrates, and Socrates it claims that he didn't know that hemlock was poisonous, right? So he's with his people. He drinks some hemlock that they hand to him. He doesn't know that it's poisonous, and he gets very upset and is shocked. And he's like, "Well, I know a lot of things." He says, I'm Socrates. I'm a genius, but I only know general things. What is truth? What is justice? I never learned the details, right? So I'm Socrates, and I know truth, and I know justice, but I don't know that hemlock is poisonous." And my father thought this was absolutely hilarious. And when I was watching it, I was like, wow, that sounds like people in bonds, right? Because people, they know general things. They're like, bonds are safe. bonds, can't lose money in bonds, right? That's what they've been taught, right? It's like the reason there was even a 60%, 40% portfolio recommendation. The 60-40 portfolio was that bonds, the role of bonds was like, that's the safe part. That's the part that's not going to be volatile. That's the part that's going to be the ballast of your ship, right? So when stocks go haywire, you have something that keeps you from losing, money. Maybe the upside isn't as good as stocks, but at least with the bonds, you'll get your 3% or 4%, and you're not going to have a 40% decline like you can have in stocks. Okay, so didn't know hemlock was poisonous. That's Steve Martin's Socrates. But did you not know that like major shocks with interest rates, like a major climb in interest rates is kind of like the hemlock being poisonous? Like if you don't understand that bonds are super sensitive to that, or if you just don't understand the relationship, because not all bonds are, the sensitivity of a bond to a change in interest rates is called duration or modified duration. And at the outset of any bond, a bond specialist can tell you the bond's sensitivity to interest rate changes. So don't fly blind. Like, don't just try to wing it. Like, you can study the modified duration. You can study, I mean, it's mathematical and it's not a mystery and it's completely known. What is the bond's sensitivity to a major change in interest rates? Okay, so what do I mean? All right, let's get to like a Starbucks bond, right? So this is, and but by the way, you haven't lost money if you're not trading this bond on the secondary market, right? So if you buy a bond, so say you loan Starbucks $1,000, right? And say you get in at the very first, at the issue, which never happens, but let's, for argument's sake, say you do. And the bond is paying 3%. So that's the coupon, right? So you're going to get your $30 semi-annually, so $15 every 6 months for the life of the bond. So say it's a 10-year bond. Say you got in at the beginning, it's paying 3%, you're going to get $30 every year, and then you're going to get your $1,000 back at the end of the 10 years. That's how that works. So you haven't lost any, even if interest rates change, you're not losing money. You're not losing principal if you never have to sell before the maturity date. Okay. And if Starbucks doesn't go out of business or not some huge, so that's the credit risk, that's the default risk, that's a separate thing. But in terms of the structure of the bond, if you paid your $1,000 and the coupon is 3%, you're going to get your $30 every year, and then you're going to get your $1,000 back. So who cares? You haven't lost money. But then interest rates change. So if you want on the secondary market to sell your bond so you get your principal amount back before the end of 10 years, well, then interest rates are really important. So and we've been through this, right? So there were bonds being issued at 3% coupon, but then interest rates rose. So the more current bonds were giving 5%. Well, no one's going to want your bond at 3%. Say there are 7 years left on your bond, right? And you just want to sell it. But the new bonds are paying 5%. Okay, in the simple math, right? So a bond that's paying $30 a year times 7, that's $210. A bond that's paying 5% a year, that's $50 times 7 is $350. So there's a $140 difference, right? So your bond is not worth as much. So that's why the price of your bond changes, because the coupon never changes. The cash payout never changes. That's why the price of the bond is going to fluctuate. And this is how people lose money trading bonds. If you hold to maturity, you haven't lost anything as long as there's no default, as long as the company hasn't gone out of business. I mean, in theory, if rates continued to climb or inflation always stayed high, you'd say, well, you lost money because of the value of the money. I mean, I don't want to get into the whole inflation nominal versus real thing, but technically you haven't actually lost money if you hold to maturity, but you do lose money on the secondary market when interest rates go up. All right, so why does this matter? Well, why were people so shocked? Because this is like, Socrates not knowing that hemlock is poisonous. people never really paid attention to the idea that they were going to lose money in bonds because for decades and decades and decades, it didn't happen really. I mean, there was a time in 1994. Okay, yes. But we had this 40-year trend of declining interest rates. So bond people were always on the winning side of this issue, right? So maybe they were holding, I mean, it would be unusual to go back all the way to 1982 and have a bond that's paying 15%. But you could have easily had a bond like the Ford bond that was paying almost 9%. And then rates slowly went down. So the person holding the 9% bond was always getting more for their bond. Year after year after year, these rates slowly declined, but the bondholders were always on the winning side because the bonds they held had the higher interest rates and the newer bonds had the lower interest rates. So their bonds were always trading at a premium. They were always making a capital gain, getting cash off of their bond, while they were also getting the yield. Hopefully, this is making sense. A 40-year trend, right? But look where this trend goes. You get down to 2000 and 2001. I mean, you are down to the 1%, right? I think that, okay, so let's look at 2000. And yeah, in 2000, you got down to a 10-year that was only paying 1%, right? Now, this is where like the Socrates and I didn't know hemlock was poisonous thing comes in. Who is buying? Who is tying up their money for 10 years and saying, yeah, okay, I'll buy that bond. I'll buy a 10-year bond that only pays 1%, which means like that doesn't change. Like I locked myself in to something that only pays 1% for 10 years. Could you not foresee that, interest rates, historically were much higher? And could you not foresee what happened? Now, maybe a lot of people, it's understandable. They couldn't foresee how quickly it happened. But to tie up your money in any kind of a long maturity bond where you're getting almost no yield and not being able to think like, well, I could lose money because I'm going to have a bond that's only going to pay $10. That's the 1%. Yes, that is the 1% over, the whole value of all of the yield is only $100. And then a 4% bond comes along and that has a $400 lifetime value. These are major, major, major disparities, right? So this is like the whole hemlock is poisonous thing. Like if you don't understand that this is how bonds work and this is why they're sensitive to interest rates, then please stay away from bonds until you do. And if you don't understand why shorter maturities are safer than longer maturities when it comes to interest rates, then, watch this video several times, ask friends, do whatever you need to do. But this is the whole point of interest rate risk. And so this is why people that were holding really long maturity bonds, when they locked in super low coupon rates with long maturities, they got just absolutely slaughtered. And nobody knows if they're ever going to recover because we don't know if interest rates are going to go much lower again. I mean, they could. Okay, so wait. So here's the thing. And so John Spooner in his book, No One Ever Told Us That, he's a lifetime money manager, 40 years in the business. And he's like, look, no one knows the direction of interest rates, right? So these poor people who owned very long maturity bonds that are really trading, at such a discount now, no one knows if they're going to be okay, if they're ever going to be made whole. I mean, it would be much, much, much less painful if they haven't sold, if they didn't sell for a huge loss. It would be much less painful if rates came way down again. That would help them. But nobody knows. Rates could climb. They could go sideways. Oh, is somebody asking a question? Oh, also, I've been naughty. I haven't checked the chat. So let me check the chat. Oops, what I'm doing. Okay, let's see. Kari did something. Let's see. There's something. I'm an AI assistant helping Karen Griffin take notes for this meeting. Oh, okay. AI assistant. Okay. Let's see. What are some popular corporate or municipal bond ETFs that are available to retail investors? Oh, that is a great question. And I'm going to get to it right at the end. And we have 11 minutes right now, so I think we're going to have time. Let me see if there's another question. Oh, okay. And then also in the chat, so Caitlin Orlando, who runs these programs for the library, you can also email her. It has her email. It's a good email to have, actually, because the library does such great programming. But she'll be able to give you that PDF of the book chapter if you're interested. What would have been a good way to short 10-year treasury bonds in 2020? Oh my gosh, are you fancy? Okay. Honestly, like I know, actually, my daughter worked for Whitehaven, and they know how to that was her summer internship, and they know how to short treasury bonds. I guess I could reach out and find out how they did it, but I don't think regular people do stuff like that. I think again, the ETF universe is incredible now. All sorts of crazy active management things are going on in the ETF universe. So maybe there are ETFs out there that short treasuries. So Whitehaven Management, I'll have to find out from them and like follow up in the next webinar and see if I got any. I doubt it's something that regular humans can do. What does it mean when a bond is callable? Oh, guys, you guys are so smart. Okay, I do. That's the last risk that I'm going to go over. I have a slide on that. We'll do that real soon. Oh, these are great questions. Okay. Anyway, so no one knows the direction of interest rates. Don't waste time on forecasts. If you find yourself watching the news, listening to podcasts, whatever, and they're like, we're going to tell you where rates are going in the coming year, just stop listening because nobody knows. Those forecasts are totally bogus. However, to protect yourself, you need to choose shorter maturities, right? So a lot of experts will say, like, you want to hang out with, I mean, if you want to be super crazy safe, you can just do the treasury bills that mature in less than a year, but I don't think you have to be that crazy. But a lot of people are just doing shorter maturities. They're not, I mean, they're not going anywhere near the 10-year. They're doing like 3 to 5 year maturities, which makes a lot of sense. Maybe 6-year, but a mix, right? So you're not totally stuck. Okay, let's see. So all right, so now we're going to talk, so that was the interest rate risk. Now we're going to talk about credit risk. So you can imagine just like every person has a credit score, just like every person has a different level of trustworthiness, just how you wouldn't lend your car to certain friends of yours, but you would lend it to other friends, right? You're not going to loan money to certain entities because they're a little dicey, a little suspicious, a little weak. So there are rating agencies, these third-party companies that literally rate the bond issuers out there, right? Whether it's a town, there are towns that don't actually have great ratings. There are, companies that don't have great ratings, obviously. There are shaky companies. It doesn't mean that you should always avoid them, but it's really important to understand that these ratings exist and also to not get confused. Because I don't know about you, but like if my kid came home with a B, I wouldn't be that upset. I'd be like, okay. But just a B by itself for a bond is terrible. I'm not going anywhere near a single B bond. Triple B bond, that's still investment grade. It's not great, but it's investment grade. A double B, okay, it's the beginning of junk. Regular B, not for me, never, never. But why do people do it? Well, they do it to get higher yield. And I kid you not, in this book, so this is one of this book, Fixed Income Investments, right? So if you get a job like in the bond world, they want you to read this cover to cover. And I was reading about like all the bond math, and they were talking about like, well, yeah, when a bond doesn't have a good rating, it just has a much higher coupon, right? So it's like, well, what kind of yield? And believe it or not, there are bonds where they have a 1 in 10 chance, 1 in 10 chance that your principal will never be returned. Okay. 1 in 10. This is like Russian roulette. And they're saying, oh, yeah, the yield only has to be like 16%. For who? Like, I mean, I don't care. I mean, I guess I care what the yield is. If you're going to pay me 50%, I only have to hold the bond for 2 years in order to get all of my, the coupon payment alone would be the value of the bond in 2 years. Oh, maybe. I don't know. I just probably never. But this whole idea that like this risk is being priced and that there are people who are willing to just go for the higher yields. I'm like, okay, 16%, never. If there's like a 1 in 10 chance that I'm going to get zero, like never interested. But having said that, and I just want to point out these are junk bonds, right? So high yield bonds are junk bonds, just in case you didn't know. So anything with the BB or BA rating or lower is junk. Okay, and by the way, this is an actual 401k menu from a very reputable company, and they have high yield, which is junk bonds. They have that listed under conservative investments because they're lumping all bonds together as conservative, and that's garbage. Okay, high yield means junk. So you'll just see these mistakes everywhere. But having said that, if you take like these pension boards, like these really smart people who work at very conservative places, like the state of Wisconsin Investment Board, those are pensions for the state of Wisconsin. Look what they're doing. Like they have a huge bond portfolio and they are allowing themselves, I mean, I would never do this, but they are allowing themselves to have 8.5% of all of their bonds be only B rated because they're chasing yield. Now they have the majority of their holdings in, double A, 52% or basically 53% or higher is double A, super investment grade, but a lot of people are going into the higher yielding bonds that have these kind of lousy ratings. I mean, I would never do it, but people do it. And I guess what they do is they just kind of mix it up, right? So they'll have some small amount of their bond portfolio that is below investment grade because they're chasing the yield and they think they can get away with it. Okay, good luck. It's worth knowing that this, even pension funds are doing this. Okay, someone had asked about call risk. So call risk is a kind of, so David Swensen, genius, ran the Yale Endowment, super famous guy, really revolutionized investing on the institutional level, and it's kind of trickled down to the rest of us. But he can't stand that bonds are callable, right? So he's like, just stay away from corporates in general. I think that's a little dramatic. I don't agree with him there. But he's like, basically the thing with callable is, say you do have some bond and it's paying 6%, and if interest rates really decline, then the bond can be called, meaning the company can just give you your money back, kill the bond, like, give you your principal back and be like, well, we're not doing that anymore. So maybe they signed on for a 10-year at 6% and they're, only 5 years in, but they have a call provision. And so they're just going to give you your money back. So you thought you were good. You thought you had a 6% yield for the foreseeable future, the next 5 years, but they can call the bond, which means that they're just going to give you your money back and kill the bond. They're going to do that because then the prevailing rates, they know they can borrow money at 4% or 3.5% or whatever. So call risk is definitely a risk. It gets exaggerated. So David Swensen's like, for regular people, he wants them to just completely avoid callable bonds. I think that's a little dramatic. And Bill Gross, the genius who ran PIMCO, he thinks that call risk is over exaggerated. So he would stick with corporate bonds that have higher yield. So there you go. You have two very smart people kind of disagreeing, but that's what call risk is. Okay, finally, okay, inflation protected. I'm just going to do this really quickly because we only have 2 minutes. But what you really need to know is you need to take yourself to Treasury Direct, right? The Treasury Direct website. It will tell you everything you need to know about inflation products, right? Because this is really just our government giving you these inflation products. And what does that mean? Well, like, you can have good coupon yield and you can do whatever, but no one's out there saying, no matter what happens with inflation, I will make sure you beat inflation, except for our government, okay? They have created products like TIPS, Treasury Inflation Protected Securities, and like I-bonds, where you are guaranteed to beat inflation. And this is really important, but you have to go to Treasury Direct. I mean, granted, you could get TIPS through your broker and stuff, but I want you to really understand what they are. So if you're at Treasury Direct and you just look at marketable securities, it's going to explain everything about treasury inflation protected securities for you, right? And you can buy them directly on Treasury Direct. You can also go through a broker, but you can buy them directly on Treasury Direct. So what are the pros and cons? So you have these tips. You also have I bonds, right? So I'm going to talk about two things: tips, I bonds. I'm rushing a little bit because we only have a minute left. I'll go like a little bit over to answer some questions. But if you know that you just want something that's protected from inflation, whatever inflation does, you're not going to make a lot of money after that, but you just want to make sure the yield you're getting beats inflation. You know, it hugs inflation, but also beats it. Then your choices are tips and I bonds. And you can get both in low increments, which is great. But the difference is tips are very liquid, right? You can get in and you can get out. I bonds are not. All right. So if you buy I bonds, you have to hold on to what you can't get your money back for the first year. And after the first year, yes, you can get your money back, but when you go to get it back, you forfeit 3 months of interest if you're trying to get your money back sooner than a 5-year commitment. All right. So tips are more liquid, I bonds are less liquid. Tips are, to me, less attractive with taxes, and I'll tell you why. So you're going to pay federal tax no matter what on both. But here's the thing with tips, and you're not going to pay state, okay, because these are treasuries. However, with I bonds, you can choose, and I don't know why anybody would choose the harder one, but you can delay paying any tax on any interest earned until you redeem the bond. So basically, you're kind of letting your tax-free compound, and I would do that. But also, you're just not paying tax, right? So you can choose, you know what interest you've earned on the bond, but you can choose to declare it on each tax return, but you don't have to. On tips, you do. So I think I bonds are much better, like in terms of being able to delay the tax bill, having that option. Finally, I bonds, if you use the interest that's accrued, if you use it for education, then in a lot of scenarios, you never have to pay tax. So that's really, really unique. But anyway, go to the Treasury Direct website, read all about these two options, but those are totally viable products where you don't have to worry about the threat of inflation. Okay, and then remember to join us. I am gonna get to the ETFs, but remember to join us next February 24th, all about the scams. It'll be interesting. It'll be fun. Certainly interesting. Okay, but some people were asking about ETFs. All right, here's the thing. I was focused more on short maturity, and someone asked about 10-year, or no, I think maybe it was corporates. But PIMCO, I love PIMCO. So you can look at all their ETFs, but like this PIMCO ETF that has the MINT, like that's a really interesting one to look at for an exchange traded fund. And then Vanguard VBIL is another interesting one, exchange traded fund. It's amazing how cheap these funds are now. So bonds used to come with like some fees, right? If you want any help with bonds, you're going to pay fees. Not anymore. I mean, the Vanguard short-term treasury 0.07% fee is like ridiculous. But then PIMCO, I mean, these are some of the smartest guys, active management smart guys in the business, and they're only charging 0.36% expense fee. So I really love PIMCO. I really love Vanguard. They have really interesting ETFs, and actively managed ETFs are just taking off. So probably at the beginning of the next webinar, I can have a few more recommendations about ETFs that are longer maturity or corporates versus treasuries or things like that. But stick with Vanguard and PIMCO would be my advice. And we are over time. Sorry, guys. Let me check the chat real quick. Let's see. Okay, I got to remember this, the shorting of the treasuries. That's super interesting. What are your thoughts on how to construct a bond ladder? Okay. Bond ladders are just very straightforward. I mean, pick things that are high quality, and you're just kind of matching up like you're, how do I explain a bond ladder? Bond ladders are like you're buying bonds to expire at certain points. Oh God, this is hard to explain. Also because I don't really like bond ladders. I'm going to save that. The beginning of the next webinar, I promise I just don't like bond ladders. Separately managed accounts are much better. So just forget bond ladders. If you really, it takes a lot of time, a lot of money. And if you have that kind of money, get a separately managed account, SMA. Okay, and register for the next section. Yes, that's true. Okay, I think that was it for the questions. You guys have been great.
Yeah,
Thank you.
I think that's it. Thank you so much, Kristen.
Sorry, I was rushing at the end, trying
No,
to get it
not at
all in.
all. Not at all. That was wonderful. And I posted obviously in the chat the link for next month's session on financial scams and fraud prevention. So click on that. We hope to see you guys all there. And thank you so much again, Kristen.
Oh, it's my pleasure. It's so nice to see all the thank yous in the chat. Thanks, guys. Thanks for listening. Thanks for sticking with me.
Thanks, everybody.
All right. See you later. Have a good night.
Have a great night. Bye bye.